Are you ready to try your hand at placing your very first stock trade? Then check out our free guide, 10 Steps to Choosing Your First Stock to Trade, the Ultimate Beginner's Guide. In this free download, you'll learn how to choose the right kinds of stocks and how to find them, know when to buy your stocks and when to sell them, and you'll learn how to take your very first steps to becoming a stock trader and much more. Grab your free guide now by going to TRADEway.com/guide. That's TRADEway.com/guide. Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God Himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, welcome back to the podcast. Today I want to talk about some common mistakes that can ruin your trading. And you know, at TRADEway, we're all about teaching skill sets that help you learn to get your money making the money. And that's what we want to do. But if you don't understand these mistakes and stop making them, then Wall Street will take the money back every time you make a winning trade. The next trade, they're going to take the money back. And that doesn't work. You know, you got to make the money, but you got to learn how to keep the money. So that's what we're going to talk about, is things that make that work in the wrong direction. Like, what are the mistakes that cause us to give the money right back to Wall Street? We don't want to make those. But here's the cool thing. If you can eliminate those, then you don't even have to get all the trades right to have potential to make money. Okay, so you get the math in your favor where you're winning bigger and having an acceptably small stop out when it doesn't go the right way. That is some great math. So you're winning big, losing small. That's the key. So just think about that. With that kind of math, if you get, say, 6 out of 10 trades right, you're doing well. So let's talk about the things that can ruin that math, though, such as breaking rules or making these common mistakes. So here's the first big category: not understanding how market tone and fundamentals affect your trade. Now, a lot of people don't even know what that is. A lot of people just literally, because the software is so great now, they open a brokerage account, they got the great software, they're running there and just make a trade and buy a stock and then run off to work. They're not even thinking about how it's really supposed to be done. So there are 3 legs on the trading table. You've heard me say it a million times, and we sort of built our trading system at TRADEway on this many, many years ago. And really that goes back 4 generations in my family, but think about it now, it's 5 and even the 6th generation, because we're teaching my grandbabies how to do this. Maybe not the babies, but I've got some teenagers now that are grandchildren, and they're learning these skills as well. And of course, all 5 of my grown children know the skills. They all work in our family businesses and they all work with TRADEway. They know these skills. So we've passed these down through the family, and that's what we want you to do, is go out to TRADEway.com and let us teach you how to be maybe the Captain Brown of your family. That was my great-grandfather that pulled us out of poverty and actually showed us about money, began to learn about money and how it worked in business. And he was in the oil business, but it can now, think about how difficult it'd be to have entry into that. But it's not difficult to have entry into a stock trading business, and that's why we teach this across the country. So what are the 3 legs on the table, though, that we've talked about through these generations? Number 1, fundamental analysis, which means how good is the company? How good are their products? How good is their management? Do they have double-digit growth of their earnings per share quarter to quarter? That sort of thing. That's the fundamentals. And as far as market tone, that has 2 components, really. It's got a news component and also the charting of the S&P, which is the index that represents the whole market. So if you don't understand those 2 things, you're going to make mistakes that you don't need to be making. And then, of course, the 3rd leg is the charting, where you can actually watch the movements of the stock over time. And they go through cycles and they tend to make patterns, and you can learn to recognize these. They're well understood and have been for decades. You can recognize them, and that's part of the skill sets we teach. But let's go back and let's talk about the fundamentals and the news component for a minute. Now, the fundamentals I'm not going to talk about that as much because TRADEway is going to help you with that. We don't expect you to go out there and get an MBA degree and learn how to run ratios on all these companies. So we actually do that for you. And when you take part in most of the educational components out there at TRADEway.com, it's going to include some fundamental analysis that's already done for you. So we're going to provide a couple of baskets of stocks, and it's called the Founders List because I'm the founder of the company and I make those lists, and we update them roughly monthly, pull out the ones that aren't doing as well, put in the new ones that are really hot. And you have 2 baskets of stocks where if you choose, and they both got about 100 in there, if you choose 1 or 2 or 3 of those to trade with, the fundamental analysis has already been done and you don't have to do it. They wouldn't be in the basket if they didn't have great fundamentals. So that's done for you. So let's talk about the market tone component. Now, we're going to help you with that through our market alerts as well, because it takes you a while of trading through bulls and bear markets to really understand what news is even real. A lot of it's fake news. A lot of it's not. We're going to help you with that with our market alerts. And we'll share with you the very articles that we're looking at that are real, that actually have to do with moving different stocks and so forth. So we're going to help you with that at TRADEway as well. But just not understanding that is a problem. So with regard to that, in the news, you need to realize that there are always 1, 2, or 3 words or phrases that actually affect the stock market. And everything else, all the other articles that you see is just fluff or maybe even fake news. They don't even affect the movement of the stocks. So you need to learn to figure out what those 1 or 2 or 3 words are. For example, right now, inflation would be the first one. The whole market rises and falls based on what they think the Fed is going to do to try to stop inflation. So a second word would be, for example, the government bonds. The interest rates of those bonds are going up. The Fed's making that happen because as those rates go up, it makes people borrow less money, and that's like printing less money. So there's less money in the monetary system, and it tends to tank stock markets. So you don't want to go out and be buying a bunch of tech stocks when the Fed is raising the interest rates and lowering the monetary balance, because eventually that creates a recession, which is going to create a stock market crash. So you have to be more careful when you see that happening. And really, for the most part of 2022 and 2023, that's exactly what's been happening. The Fed has been raising the rates 11 times at this point. And so the monetary system is, the amount of money out there for people to use is dwindling. So the banks can't loan as much. So you can't start new businesses. You can't finance the ongoing businesses, and it creates a recession. We're going to probably see one pretty soon. And just knowing how that kind of news affects your stock trades is really important. So like I said, there's usually 3 words or phrases right now. Inflation would be one. Interest rates would be the other. Just the phrase Fed, like whatever the Fed is going to meet and do, that affects the market. And so those are the ones we're looking at right now. And you need to always know what those are. Now, we help you with that at TRADEway when you take part in the educational system. You'll get market alerts that will show you what the main 3 words are. It'll be talking about them. And then every once in a while, one of those 3 will drop off and a new one will come in. Then you need to know what that new important thing is, that word or phrase or idea that's affecting the market. But just remember, most of the other news that's not about those 2 or 3 things is fake. I mean, it's just fluff. It's actually Wall Street trying to get you to do the opposite of what they're going to do. And you say, well, why is that legal? Well, it just is. I guess it's freedom of speech, right? So they'll be saying, oh, you really need to be jumping in and buying these stocks. Well, it's because they're about to sell them and they need someone to sell it to, right? So about the time you jump in, they sell it, it drives the price down and you stop it out and lose money. So it's important to understand what the key words are, the real words that drive the market and the phrases and so forth. Now, here's another thing. The longer your stock trade is, for example, a step 1 or step 2 stock or options trade generally lasts about 2 to 3 weeks. That's not very long, is it? But we have some in step 3 and 4, more advanced trades that last a day or up to 3 days, 1, 2, or 3 days. That's really short. And then we have some that we teach in our really advanced courses on longer term trading that can last 9 months, 12 months on a trade. So here's my point. The longer you're in the play, the more important the fundamentals and the news become. So think about it. If you're doing a 2-day trade, it really doesn't matter what's happening in the world because it doesn't have much time to affect your trade, right? It doesn't much matter the fundamentals of the company because the company's not going to go out of business in 2 days, most likely, right? So my point is on these shorter trades, like 1 or 2 days, the fundamentals and news don't matter as much. But you go out to the typical trade that we teach in step 1 and 2, about 2 to 3 weeks. You may say, well, that's short too. Well, yeah, but it's long enough that the fundamentals and the market tone and the charting are all important, and you need all 3 legs on the trading table for those trades. Now, if you go out longer, like a year, like what we do with what we call our 80% money, where our AMPed program, which invests people's retirement money, is looking at a 3 to 5 year time frame. And so fundamentals and market tone become the most important. And the fundamentals of the whole market happen to be the economic facts and the economic news. And so knowing that is really important, and it makes a big difference on your trades, right? Now, with regard to market tone, remember I said there are 2 components. One is the news that we just talked about, but the other is knowing how to chart the S&P. Now, the S&P index sort of represents the whole market. So if you apply the charting skills that we teach at TRADEway, basically in step 1 and step 2, you learn the patterns, you learn how to draw support and resistance lines, and you learn the charting skills. That becomes really important because you can apply those same skills to the whole market. You can chart the S&P and draw support and resistance lines. You can look and see where the moving averages are, and you can begin to see what the market is telling you that its cycle is doing. Where is it in its cycle? The cycle of a bull market, is its lifetime just about over? Is it going to turn into a bear? Is this bear market cycle about over? Is it going to turn into a new bull? And all that, a lot of it has to do with not only the news, but also the chart of the S&P. So if you know your support and resistance lines and the key moving averages, and you understand this one concept, it's called reversion to the mean. And the reason that's important, and that just means the average, the mean means the average. The reason that's important is because almost everybody on Wall Street, if they have a college education, they've got an MBA degree. And in the MBA programs forever, I was in the program years ago, and now they still do it. They teach reversion to the mean as the main indicator of what a stock is about to do. So they will chart these stocks, and as they bounce up and move up away from the moving average line that your software will draw, it becomes more likely that it's going to turn and move back down because it tends to pull back towards the mean or the average. So it's going to pull back down towards that moving average line eventually. So that's why it's important to sort of buy the stocks right when they bounce up off that moving average and then sell it when it's far removed from it. And that's just the things we teach at TRADEway, and it's how the big boys do it. It's how my family's done it for generations, and it works great, and we teach you exactly how to do that. But for people who maybe come and they learn these techniques and then they don't use them, for example, they will let a particular stock hit the support line and maybe the 20-day moving average and bounce up. 2 or 3 days go by, it keeps going up, and it's halfway up towards the sell point, and then they'll buy it right there. That is a terrible practice because you want your buy point to be right at the place where it just bounced up off support and the moving average line that it likes to bounce off of. You don't want to wait till it's moved halfway to the place where you should be selling it. That's a bad buy point that leads to bad stop outs if it goes the wrong way and lower profits if it goes the right way. Now remember, if you're supposed to win big and lose little, and you jump into the play when it's halfway up the channel, it's only going to make half the profit. So you're not winning big, you're winning little. And then if you stop it out, on the other hand, it moves down the other way half the channel and you lose big. So now you're winning little and losing big, and you're going to get nowhere. You're going to think you're a terrible trader when really all you're doing is not understanding this one thing, and you're making this mistake. You're breaking this rule that you don't want to get late buy points. If you miss the perfect buy point, skip that stock and go find another stock that's at a good buy point. Does that make sense? Okay, so that pretty well covers this first major mistake of not understanding how market tone and fundamentals affect it, and how even the charting of the S&P. Now, you see, here's another thing is maybe your individual stock is kind of looking like it's at a good buy point, but the S&P is far removed from the moving averages and far removed from its support line. In fact, it may be already at the resistance line. It's about to bounce down. Well, you don't want to be doing an up play on a stock when the whole index or the whole market is about to go down. So that's why that charting component of the S&P is important. It shows you what the whole market's going to be doing. And you want to keep your stock trade in line with the market, not going against it generally. Okay. Now, the last thing about understanding the charting component of the market tone is you need to understand what to do when a pattern changes. For example, if the S&P has been in a range bouncing up between a certain support and resistance line for 3 months, and all of a sudden it tanks below the support line and below the moving average that it likes to bounce up off of, and it closes below those lines, well, it looks to me like the pattern's changing, right? Well, what do you do when the pattern changes? The best thing to do is just stop and go to cash and just wait and see if it'll come back up into the range, in which case you can resume trading, or it might start a new downtrend, and you might start looking at buying puts, which can give you the potential to make money when the market's going down, but you don't want to go against what the whole index, the whole market is doing. So that's all part of the first mistake, which is not understanding the fundamentals, not understanding the market tone, and even that charting component of the S&P, that part of the market tone. If you go against the grain, you're going to get in trouble. Now let's talk about a second big mistake. Trading in stocks that are not making well understood and reliable patterns. Now, when you go to TRADEway.com and you select almost any of our educational components, they're going to teach you the basics of recognizing patterns, common patterns that stocks make, understanding how to draw support and resistance lines, and so forth. But here's what's true about that. Not every stock, let's say you're looking at the 100 stocks, some odd stocks that are in the founders list, and you're going through looking at all of them on a chart, what you're going to see is there's never a time when all of them are making recognizable patterns. Well, that's good, because you just eliminate the ones that aren't. You don't trade in those stocks. So if you go into the founders list and you got about 100 stocks and you start looking at them and you find 70 of them that have a really good pattern that you recognize and 30 that don't seem to be doing anything, then eliminate the 30. Now you're going to take those 70 and narrow those down to the 4 or 5 that have the prettiest pattern that you like, that you personally like the best, because there are many patterns and you'll have your favorites. And that will eliminate another 60 or so, and you'll have 10. And then out of those 10, you're looking for the ones that have the best 2 or 3 that have perfect buy points right now today. Those would be the ones you could trade in. So one of the big mistakes is that people will go ahead and jump into a stock and they'll lose money, and maybe they'll send that to me or one of our coaches and say, okay, would you evaluate my last 5 trades? What did I do wrong? And 2 out of the 5 trades, I write the note, could you please tell me what pattern you saw? And they can't tell me because there's not one. And that is a terrible mistake, and I don't know why people do it, but they do. So you need to eliminate that one. Just don't do a stock play or an option play on any stock that's not making a clear, reliable, repeatable pattern that you understand and that you've learned. All right. Now, the third big mistake that I see people making is taking advice on which stock to buy. I don't care if it's from your mom or from uncle, at Christmas, or an email subscription that you took, or articles online or on television, where people are telling you what stocks you should be looking at. Just don't listen to it. You need to pick your own stocks and you take them out of one of those 2 founders lists, because we've already done the fundamentals for you. And there's a couple of 100 there. You go in and pick your own stock and know why you're doing it. You're doing it because it's got great fundamentals and because you understand the pattern and it's at a great buy point, not because Aunt Bessie said, oh, you should buy this stock. I just bought 100 shares and it's going up, up, up. That just doesn't work. Do not take advice from other people on which stock to buy. You need to pick your own stock. And at TRADEway, we're going to teach you exactly how to do that the right way. For one thing, if you sign up for somebody's email subscription, I've seen time and time again, the list of stocks they send you are not growth stocks, which is what you should be using for stock trading. They're sharing with you value stocks, which is what you use for buying and holding. If you're going to keep the stock for 10 years, yeah, that's a good one maybe. But if you're doing a 2-week trade, that is not the right stock. And so that's why these email subscriptions don't usually work, because they're giving you the wrong style of stock for what you're doing, which is a 2 to 3 week trade. So number 3, that big mistake is letting other people pick the stocks for you. You need to do your own stock picking. I can remember sitting on my grandfather's knee when I was a little boy and listening to him talk to his stockbroker, because back then you didn't have internet trading, right? So that stockbroker would be feeding him 2 or 3 stocks that he wanted my grandfather to buy. And he would cuss at that dude. My grandfather was rough. He would cuss at that dude and say, look, I don't need your advice. I've already picked my stocks. I need you to buy 100 shares of this, 200 shares of that, 500 shares of that. And he would tell him the stocks he wanted because he had already done his research, and he never took that kind of advice from the stockbroker. So that's kind of what we're talking about. Now, let me give you the 4th big mistake, and that's being in a trade during the earnings report for that particular stock. Now, that's something we teach our very beginners, is when you're in a play, you need to check and see when that stock or when that company does its earnings report, which they do them every quarter, but you need to know the day. And you need to end your play at least the day before that earnings report, even if you don't think the play's over. It is too risky to stay in it during the play for this reason. You may think that it's going to have a great earnings report, but if you go out and look historically, about half the companies that have a good earnings report go down the next day, not up. Okay, so you can't predict it. It's impossible to predict it. So get out of the play. Don't be in it during the earnings report. Now, we say that pretty much that strongly every time we do an event for beginners, and yet people break the rule. I don't know why. It's a gambling instinct. It's pride. I don't know what it is, but you can't win if you're going to let those kinds of emotions rule your trading. So the rule is get out the day before the earnings report. And not doing that is a very bad mistake, because sometimes these things gap, and it may gap down $15 in one day, and you're in a play to try to make money when it goes up, and man, you get slammed. So just don't make that mistake, please. All right. Now, the last one I want to mention today is this: bad money management. Now, that is when you put $3,000 in this trade and it works so well that the next trade you say, well, I'm just going to put $7,000 because I know this one will be even better. That is going to be a big mistake. And you know what? That is a thing that's so important. I'm going to do a whole podcast on that next time. So be sure and show up next time, because we're going to talk about bad money management and what the right way to do money management is, and why it's so important to even know about it, because a lot of people don't, and it can make or break you as a trader. So it's really important, and can't wait to talk about it next time. I hope you'll be there. Well, if you like the show today, please rate and review it. And that way people with similar interests can find us. We want to be a help to them too. And I hope you have a fantastic day.